Perfect. What's up, family? This is Joe. Welcome back. I'm really here just to share with you guys three key confirmations that I use every single day, a part of my trading style, trading strategy. So you guys already know I trade Wyckoff, time smart money concepts, and I keep these concepts extremely simplified, just because I feel there's no point in making things difficult. So now the first three key confirmations that I really look for, the very first one is going to be market structure. We're going to get relatively deep into each one. So I really don't have anything to say about market structure. Number two, it's going to be where the banks. We're ultimately looking for certain type of candlestick patterns. And then three, I'm just simplifying Wyckoff, really showing you guys how we get the tight stop losses and the big risk rewards. So let's get into it. First things first is I always ask myself, what is the trend? Are we in an uptrend? Are we in a downtrend? Are we in a continuation, or have we broke structure? In my eyes, we have four types of trades that we can take. The very first one is going to be the continuation in an uptrend, the uptrend continuation. So let's hop into it. So we understand if price is making highs and respecting our lows, making new highs and respecting our lows, making new highs and respecting our lows. This is an uptrend. We can see prices moving up. Price isn't going to just shoot straight up because price has to move balance. So it's always going to go up. It's going to have this expansion. It's going to retrace. It'll actually consolidate for a little bit and have its next expansion. So those are some of the characteristics of the market. We do have higher highs and higher lows. Is what we look for in an uptrend or a bullish trend. So ultimately, whenever we're bullish or in an uptrend, we're always going to look to buy the higher lows. So now the reason why we're looking to buy the higher lows is simply because we want to buy at the higher low so we could catch the next anticipated higher high. So our characteristics, higher high, higher low, and we expect in an uptrend for price to be respecting our lows and making new highs. Respecting our lows and making new highs, we can clone this. And just walking price up, we're down at a swing low, at a significant low. We then push up to a high. After that high, we come down to a higher low that makes a higher high. So now how I actually look at structure, like how I confirm my higher lows, is I start off by identifying my high first. So once I identified my higher high, I then go back and I look at the low that made this higher high. And that's right here. So something that's really important is your higher low isn't a higher low unless it actually makes a higher high, which is the one reason why I start off by identifying my higher high and then going to the higher low that made the higher high. Hopefully that makes sense. So now going to a continuation for a bearish trend or a downtrend. Ultimately, for a downtrend, our characteristics are always going to be, we're going to create lower lows and lower highs. And the most important part about a downtrend is that we're respecting our highs. As long as we're respecting our highs and making new lows, we can continue to say that we are still in a downtrend. So just walking us through it, we come from a swing high or a significant high, push down to a low, retrace to a lower high, expand to a lower low, retrace to a lower high, expand to a lower low. So just like with the highs, just like for the uptrend, I start off by identifying the high first. So with the downtrend, I'm going to identify the low first, and then I'm going to find the high that made this low. So from this low right here, the high that made this low is right here. So this is my lower high that made this lower low. If we start off at this lower low, what high made this lower low? This lower high made this lower low. So now I have a question. if we go back to the uptrend, let's say price does something like this. Price pushes down, pushes up, and then pushes down. Actually, let's not get into this. Oh yeah. Okay, perfect. So would you consider this a higher low? Now, I hope you said no. The answer is no, this is not a higher low. And the reason why this is not a higher low is because this failed to make a higher high. So we need our higher low to make a higher high, or we need our lower high to make a lower low. If it doesn't, it is not an actual lower high or higher low. Perfect. So now we're gonna go through that example one more time towards the end. And yeah, so now looking at the actual break of structure. So we just covered in an uptrend. In an uptrend, we have our higher highs, higher lows. Most important thing is to respect our lows, and we want to buy at the higher lows. For a downtrend, our characteristics are lower lows and lower highs. The most important thing is respecting our highs, and we want to sell from our lower high. Sell from our lower high. Now, keep in mind, our lower high has to make a lower low in order to be a lower low. Our higher low has to make a higher high in order to be a higher high. Those are just some of my personal rules, just that we came across just from back testing. So now getting into actual breakup structure. So let's say we're starting off in this uptrend. If we're marking structure, we come from a low, we push up to a high. We then have our higher low that makes this higher high. But keep in mind how I'm really looking at it. I'm identifying my higher high first, and then I go to the higher low that makes it perfect. Higher high first, go to the higher low that makes it. So this is my last higher low to make a higher high. Once we identify that and we get this break of structure, once price pushes below this higher low, once price disrespects the low, once price disrespects the low, and then we get a lower low, that's now the characteristics of a downtrend. So if that's the characteristic, if that's the first characteristic of a downtrend, we just got a lower low. The next thing I'm actually expecting is to get a lower high and sell from the lower high to catch the next anticipated lower low. So now let's say we're in a downtrend and we're breaking structure to the upside. We're obviously going to have this low. We have this lower low as well. That was made from this lower high. We have this lower low. That was made from this lower high. Then we have this lower low. That was made from this lower high. So once price decided to break structure, break above this lower high that made this lower low, and create a higher high, we then understand, okay, this isn't a characteristic of an uptrend. This is a characteristic of an uptrend. So if we just got one of the characteristics, we should then expect the next characteristic. So if we just got a higher high, we should now expect a higher low to buy and catch the next anticipated higher high. So those are the 4 types of trades I'm personally looking at on a day-to-day basis. We have our continuation uptrend, continuation downtrend, break of structure downtrend, break of structure uptrend. So now it's relatively simple. We're looking to buy the higher lows, sell the lower highs. So getting into actually how do we look to pull the trigger and why? And why? So for the buy continuation, we do understand that looking at price, we came from a low point and we made a high point. We then retraced down here and we made a higher high. Once we confirm this as our higher high, that confirmed this as our higher low. So for an uptrend, the most important thing is for price to respect our lows. So if this is an uptrend, we would expect price to 100% not break. 100% not break underneath this low. And if it does, we're no longer in an uptrend. So all that we're going to do is look for something that we call an engulfing candlestick pattern. Now, you will hear me call it multiple things. You'll hear me call it a point of interest, a POI. You'll hear other people call it an OB, which is an order block. But ultimately, all that this is, it's an engulfing candlestick pattern. And if you don't know what an engulfing candlestick pattern is, you can download this app called Japanese Candlestick Patterns on your phone. And it's a really cool app for beginners, really walking you guys through candlesticks. You can learn a lot of information in a small amount of time just from your phone. So ultimately how I look at it is one candle in one direction and the next candle in the complete opposite direction. And it's at least 100% bigger than the next candle. So ultimately, like the psychology behind this, let me walk you guys through. Let's shift over here, is understanding that we trade with the institutions. So this market is extremely manipulated, and I actually have a little drawing right here that's going to actually break down exactly how it's manipulated. So ultimately, we have something in the market called liquidity. Liquidity is ultimately money. Now we see money in the form of stop losses, buy stops, and sell stops. So with that being said, the market makers, the market movers, they will decide to manipulate the market and print patterns. So I'm sure we've all seen this pattern, a triple top or a double top, whatever the case may be. And we're actually taught to sell away from it. I'm not sure if you guys really understand that. From a triple top, we're taught to sell away from it. To like this is support, and prices hit the ceiling, hit the ceiling, hit the ceiling. My fault. I said support. Like this is resistance. Like this is resistance. I don't use support and resistance. I'm like this is resistance, and prices hit the ceiling a couple of times, and we're expecting it to run away. So yes, that can play, but what typically will happen is this: the institutions will notice, okay, price pushed up here and we have a bunch of sellers. Price pushed up here, we got a bunch more sell orders come in. Price pushed up again, a bunch more sell orders come in. So right now, let's break down our actual orders. So there's a bunch of sellers at this orange line. This orange line right here is going to be a bunch of sell orders that came in based off the double top. Now we do have buy orders down here, because we do have a double bottom as well. So we have buy orders as well. So we have sell orders and buy orders, people looking to sell, people looking to buy. And this is all throughout the whole world. This isn't just in your trading group. This isn't just in your trading community. This is every single person in the world looking at this chart. They're either going to be looking to sell this or looking to buy this. Or we have the traders that are looking for the breakout, which are buy stops and sell stops. So meaning once price actually decides to break out, they're going to activate these orders. So let's say, or not let's say, what will typically happen is price will come up one more time and give you a little reaction. So this is enticing the sellers, letting them think they're right. And then what will happen is the institutions already understand that there's going to be liquidity up here, and they're going to drive price up. They're going to drive price up, and this is pretty much just them entering buy orders. And as they enter these buy orders, keep in mind, this is where they got into their position. I'm going to put a snipe. They got into their position right there. That was their buy position. Now, from here, after capturing this liquidity, they then decide to actually sell the market all the way back down. And this is known as our engulfing candlestick pattern. This is known as our FU candlestick. This is known as our point of interest. This is known as a lot of different things. But all that really matters is you actually understanding what's happening. So keep in mind, we had liquidity at the top, we had liquidity at the bottom. So what this is going to do is once the institutions decide to buy price up, it's going to hit all the stop losses from the sell orders. It's activating the buy stops. So now keep in mind the buy stop losses are back inside this trading range. From here, the institutions decide to sell price. So they entered one buy, they're still in it. They decided to sell, and now they're still in both positions. So now they messed over all of the sellers. They messed over all of the buy stops and captured all of those stop losses, all that money, as well as any sell stops that were down here. Any sell stops that were down here just got activated. Keep in mind, their stop losses are inside the trading range as well. So all these orders are getting activated, but all that's going to happen, literally you guys could backtest this for yourself. I don't expect you guys to take 100% of everything that I say. Really eat the chicken and spit out the bone. But what will typically happen is price will then retrace from here. And the reason why price is retracing is because we understand the banks entered two positions. They entered a buy and then they entered a sell. So currently, if the banks have a buy position and then they have a sell position, and currently where price is, let's say we're still currently down here where this black line is, our buy position, if we were the banks, would be negative. Our buy position would be negative. Does that make sense? Because if we bought from right here and we're underneath it, we're negative. Neg. And our sell position, if we sold from up here and we're all the way down here, we're positive. So right now the banks are positive in their sells, but they're negative in their buys. So ultimately all that we look for is for the institutions to drive price up and to close out of their buy orders. That's what's happening. So price drives up. This is where institutions close first order and continue with second. So this is where the institutions will typically mitigate out of their positions, close out of their first order, continue with their seconds. And this happens over and over and over again. So let me ask you guys a question. Has there ever been a time to where you were in a trade and it starts playing out relatively good, and then price just hits your stop loss, takes you out, and literally right after it takes you out, it flies in the original direction? If that's happened to you, it's because the market is meant to move like this. It's meant to happen to you. So that's the psychology behind us looking for these engulfing candlestick patterns. We're looking for price to come back to it because the institutions need to close them out. They need to close out their orders and continue with the price. So looking at our continuation for our buys, we understand, okay, price has this higher high. We then want to identify the low that made it, which is right here. And we have this higher high, and then there's a higher low that made it over here. So we're in an uptrend. We expect price to not break below this higher low based off of just structure. All we're going to do is identify our point of interest, identify our engulfing candlestick pattern. And I personally place a limit on the open and the 50%, splitting my risk. So if I normally risk, let's say I'm normally only risking 1/4%, I'll split my risk of 1/4% between both. And that's how I personally trade. So now for a sell continuation, all we're looking for is the same thing. First things first, we need to identify structure. So this is our low, it's our lower low. And what made this lower low? This lower high up here, this lower high up here made this lower low. Before that, this was the lower low. that was made by this lower high. And before that, this was the lower low that was made by this high up here. So we have lower low, lower high, lower low, lower high, lower low. So ultimately, if we're in a downtrend, we expect price to continue to respect our highs, which means price cannot break this high. So all that we're going to do is place our limit on our open of this point of interest and the 50%, splitting our risk. So let's say for this example, we're going to only risk 1% on the trade total. All we would do is risk 50% here, 50% here. If they both get activated, your 50% has a better risk reward. If one gets activated, you at least got into the trade. So now looking at our next type of trades, we have our break of structure to the downtrend. So ultimately, all we have to do is really just identify structure once again. So if we just draw this up relatively quick, we have this high that was made from this low. We have this high that was made from this low. And we have this high that was made from this low. Do we see that market structure? So once price pushes down right here and pushes up from here, let me ask you guys a question. Is this a high or low? So if you said no, you are correct. If you said yes, unfortunately, you are wrong. Now, the reason why this is not a higher low is because keep in mind, we need our higher lows to make a higher high. If it doesn't make a higher high, it is not considered a higher low to us. So our last higher low that made a higher high is right here. So this is where we're looking at a structure. Once structure disrespects this, once this gets broken, a break of structure, what that's going to mean is this was our last higher high. Obviously, this was our higher low, and we just got a lower low. Once we get that lower low, ooh, this is wrong. Once we get that lower low, we then understand, okay, so we just got a lower low. We understand that is one of the characteristics of a downtrend. So we should expect that lower high to catch the next anticipated lower low. So this is where our lower high should be. We're going to identify our point of interest, drop our limit on the open and the 50%. And all I do is I use my Fibonacci tool to measure it out. So I personally just drag, click, and these are the settings for the Fibonacci tool. It's literally just the 0 and the 0.5. 0 and the 0.5. So now, last but not least, we do have our break of structure to the uptrend. So what that looks like is, once again, just marking up structure. We have our low that was made from this high. We have our lower low that was made from this lower high. We have our lower low that was made from this lower high. And we have this lower low that was made from this lower high. Once we understand we are in a downtrend and we just get this break of structure right here, this is now our higher high. We understand that's one of the characteristics of an uptrend. So we should expect price to be in an uptrend. We should expect a higher low to catch that next anticipated higher high. So all we're going to do is look inside here and see, okay, is there any engulfing candlestick pattern? Is there any point of interest? Okay, yes, there is. Perfect. So now, since there is, all I'm going to do, I'm going to place a limit on my open, on the open of that candle, and on the 50%. And we're just taking it off of the first candle, not the second candle. We're literally looking at the first candle. Perfect, perfect, perfect. So just quick little recap. We've gone over structure. We've gone over structure, and we've gone over our points of interest, where to find the banks, as well as we've gone over the manipulation on like exactly why the banks or why these positions actually why these actually work ultimately. So now, last but not least, we do want to talk about Wyckoff. We do want to talk about Wyckoff. So exactly like how we were just saying, the point of interest, we place a limit. So we're going to get into one example quickly after this, but sometimes if you were to place a limit on the point of interest, you're going to have a really, really, really big stop loss. And nothing's wrong with the big stop loss, except for the fact that you can't crunch your risk to reward. For example, let's say you have a 30 pip take profit and you risk 10 pips on it. That means you would have a 1 to 3 risk to reward. But if you, instead of a 10 pip stop loss, you had a 1 pip stop loss, that would change your 1 to 3 to a 1 to 10, meaning for every $1 you'd make, instead of making $3, you'd make $10, which is why I personally trade Wyckoff. So now how to actually look for that, how to actually kind of understand it is ultimately using the very first 2 steps, using structure and looking for our point of interest. So let's say we're in this uptrend and we expect to buy at the higher low to catch the next higher high. All we're going to do is identify our point of interest, identify that sell to buy candlestick or that buy to sell candlestick. And then from there, once price gets into it, we're going to look on the smaller time frame and just wait for a break of structure. So once price gets into our point of interest, it literally taps into it. That first break of structure confirms that, okay, we were just in a downtrend. Now we're in an uptrend. I'm going to look to buy at the higher low to catch the next anticipated higher high. And it's just continuing order flow. And same thing with the break of structure example. So we're in an uptrend, making highs, higher low, higher high, higher low, higher high, higher low, higher high. This is our last higher low that made the higher high. So once we broke underneath the structure, this confirmed our lower low, which means we are now in a downtrend. So once we understand we're in a downtrend, we understand, okay, we should get a lower high to make the next anticipated lower low. I'm going to identify my point of interest, which is right here. Identify my point of interest, send to the back. And then from here, all I'm going to do is get on the smaller time frames and wait for price to break structure. Once we break structure on the smaller time frames, we just got that lower low, catch the lower high to catch the next anticipated lower low. And that's ultimately the 3 key aspects to my trading strategy, how I trade. And I actually have a live trade that we actually caught on Monday with the team in my free Telegram, So it's going to be on Bitcoin. We could see our take profit did smash and it reversed right after. So it's all good as long as we were able to collect our position, and it wasn't a small position. It was a nice 1 to 25. So for every $100 or every $1 you make, you're going to make that $25. Every $100, you're going to make that 2,500. So yeah. So first things first is market structure, is what is the trend? And we understand from this low, we push up and make a high. Our next higher high is right here, which was made from this low. Our next higher high after this higher high was right here. That was made from this low. So once price decided to break this higher low, it decided to disrespect it. I personally saw this as a lower low. So then at this point, we could anticipate if this was a lower low, I expect a lower high to come to catch the next anticipated lower low. So now we can see we didn't catch the next anticipated lower low, but due to Wyckoff and how small our stop loss was, we were able to have a relatively big payout on a small trade. So understanding just based off of structure, we're now in a downtrend because based off of right here, I'll show you guys. All right, so we are now right there. We're now in a downtrend because we broke beneath all of this structure to the left and made a new lower low. So we would expect price to retrace and then continue falling. So our second step is identifying where the actual institutions are. And we can see we have this candle that buys up and has this big sell off down. Now I know what you guys are thinking. You guys are like, Joe, this isn't engulfing. What's going on? Now we do look for that engulfing candlestick pattern, but sometimes it's more so just the buy up before the huge sell move, not even the engulfing pattern. But as I was first learning, all I did was stick to just the engulfing candlestick pattern. And that's really, it allowed me to train my eye and to get ready for this. But yes, so this was our engulfing candlestick pattern. This was our engulfing candlestick pattern, and which was also our point of interest. So all that we did from this point is get onto the lower time frames and wait for price to break structure. So obviously, how I personally mark up is a little bit more advanced. I'm pretty relatively deep into Wyckoff, but just to keep it simple, let's hide this. Perfect. So first things first is we understand this was the open of our 15-minute candle, of our 15-minute point of interest right there. That's the open, just so we have that. So if that's the open and we understand, okay, our last step with Wyckoff is we're waiting for price to build structure and then break structure. That's all we're looking for. So once price does this, we have 1 drive, 2 drive, 3 drive, 4 drive, and then we have this break of structure right here. This is our BOS. This is our higher high. This is our higher low. This is our higher high. This is our higher low. This is our higher high. This is our higher low. So based off the structure, we can see we have our higher low, higher high, higher low, higher high, higher low, higher high. We're literally just walking structure up. And once we have this break of structure right here, this actually confirms to us to identify our point of interest. Literally same thing. All we're going to do is identify our point of interest and place our limit. So now this allows us, if I could clear this out, this allows us doing this instead of us taking the stop loss. Keep in mind, our original stop loss would have been all the way above that first 15-minute candle. So if we go to the 15, if we're looking to take an entry based off of just this candle, this would be the trade we're going to be looking at. Above this high, above this wick, and then we're looking to take it to fill the imbalance. So this would have been about a 1 to 4.5 if we were to catch the trade from the actual 15-minute. But since we were able to actually scale in, and identify the actual Wyckoff inside here, our buyer's climax, automatic rally, this is our change of character. We get a secondary test, an up thrust after distribution. And then once we broke this structure, we are expecting an LPSY, a last point of supply. And from here, we could let the price play. We tap in and price flies. We tap in and price just absolutely goes crazy. And if we just exit out, we could see from here, what do? We just sold off. We literally just sold off like crazy. Now we did have another 5-minute entry from right here. The 5-minute candle is all of this right here. We were able to stack another entry and just keep taking it down all the way into this imbalance. This is where we took partials. This is where we took most of our position, and then price ended up reversing and literally going the complete opposite way. But look at this position. We had the opportunity to catch a 25-1 in, let's see how long this took. In 3 hours and 30 minutes. And there's people who don't catch 1 to 3s in months of their trading. So Wyckoff has really been able to really help me sharpen my skills, to raise my risk to reward. And think about it like this. If this is a 1 to 25, before this, I could realistically, out of 25 trades, I could lose 24, win my 25th one, and still be up a little profit. So this is the benefits of how I trade, family. I hope you guys were really able to find some value from this. Just keep in mind the 3 key things, the 3 key confirmations that we use to trade. It's going to be market structure, where are the banks, and Wyckoff. I hope you guys have a great day, family.